Good afternoon, everybody. Welcome to the Moving Markets Podcast. It is Monday, June the 2nd, 2025. Right now, at the time I'm recording this, there's about 25 minutes left until the markets are actually closed for the day. And somewhat surprisingly, I say surprisingly because the way things started out this morning, I don't think anyone would have expected this, but somewhat surprisingly, we are up on the S&P 500. We're up on the NASDAQ, and it looks like the Dow is just like less than a point from being positive, maybe a point and a half away from being positive. Um, for all intents and purposes, call it flat because the 1.7 that I'm showing, 1.72 points that I'm showing right here is not enough to even register 1/100% to the downside. And the Dow's been down as much as 300 points since the open this morning. So to claw all the way back and be close to a break even, and who knows what's going to happen in these last 20 minutes of trading. I mean, the NASDAQ's having a good day right now, up 0.2%. The S&P up a little bit over 0.3%. Those are both solid gains for a single day. But both of those spent time in negative territory earlier in the day, and so it's a I would call it a pretty decent comeback for the trading day today. Things got off to a really rough start because there was news over the weekend about China making claims that the United States was not agreeing to its part of the trade bargain, at least the things that have been discussed and the things that have been talked about so far. The U.S., of course, towards the end of last week, accused China of not living up to their side of the bargain. So you got that back and forth, that tit for tat. I think the markets, I think the general feeling of the markets are kind of like, now we're kind of getting used to this. Now we're sort of not getting panicky, not getting freaked out about this. It's probably going to continue like this. There's going to be this back and forth. There's going to be this tit for tat. And eventually things are going to get worked out. I think that's starting to become the more pervasive attitude. Now, time will tell. You could have some definitive news, something really solid and concrete, like China has walked away from the negotiating table and this is a full-blown trade war. That type of a headline would absolutely sink the markets, at least for a short period of time. You could have the opposite of that. You could say that the United States and China have come to a firm deal that both sides have agreed on, and there's a date scheduled for signing it. Something like that would be just an absolute huge boost to the market, and you would see a new leg and without question, a new leg up on these markets. So, like I said, time will tell. The next leg up, if it comes, is going to take us back up to all-time highs. It's going to be new records for the S&P, the NASDAQ, and the Dow Jones Industrial Average, if in fact that takes place. So, like I said, time will tell. We'll see what will happen. A little bit of other news going on. Steel tariffs. Trump's decided to up them from 25% to 50%. Every time there's a new tariff mentioned or there's mention of a tariff increase, my default, and I wish there were I think there's becoming a larger percentage of people that feel this way. I wish it was an even larger percentage than what I suspect it is. I think it's probably a 35-65, with the 35 being the way that I think and the 65 still being the other way. But I wish more people, when they hear that news, their default would be not a big deal. This is a negotiating tactic. This is not going to sink economies. This is not going to cause consumer inflation to go up. This is not going to, cause across the board price increases everywhere. This is part of the negotiating tactic. And I think that is so critical that people start thinking that way and realizing that we have ample evidence of that history and even recent history has shown that this is a negotiating tactic more than it is a trade war or even a salvo in a trade war. Now, some other news that I think is having a little bit of an impact on the markets and may continue to have an impact on the markets is the stuff going on with Russia and Ukraine. We've mentioned it several times. We've brought it up a number of times in this podcast. I worry about further escalation there and how that shakes things up and how the markets might react to that. And we got a little bit of that over the weekend. It's kind of a mixed bag of news that we got. There was a drone attack carried out by Ukraine, and apparently it took out a number of high-end bombers in Russia. And this drone attack actually occurred on Russian soil. That's not inconsequential. I mean, that's kind of a big deal. Number one, there's people that don't even think Ukraine has the ability to do that kind of thing, and it's however much of a tactical victory it is for Ukraine, it's a slap in the face to Russia. I mean, that's going to be a hard one for Putin to swallow, that he got hit on his own soil to that degree. Someone estimated, I think, $7 billion in damage taking place to the Russian war machine. That I think would have shaken markets up even more than it did, except that was followed up less than a day later with a news report that Zelensky and Putin are going to sit down and talk, that there is going to be a face-to-face meeting with these two leaders, and they're going to talk. And I think Trump and his administration are putting as much pressure as they can there in the hopes of getting a peaceful resolution. Now, what does this have to do with the markets? Well, look, we're tied into Ukraine financially. We're spending a lot of money there. There's a big debate going on right now amongst members of Congress, the House of Representatives and the Senate, about whether we should still be spending money on Ukraine, whether we should still be funding their war apparatus. There's debates about how much pressure can we afford to put on Russia in the way of sanctions, in trying to drive down oil prices, because that would be quite crippling to Putin's war machine. And these are things that can directly impact the markets. If this situation over there, no pun intended, but if it blew up, if it escalated beyond what it is, and it's already pretty bad for these two countries, it's pretty bad. If we reach a point where other countries feel the need, whether it's NATO countries, whether it's an ally of Russia, if they feel the need to get more directly involved than just helping to supply and fund Ukraine, or just helping to supply or fund Russia, if other countries start getting involved, then does it become a world war? Do you have World War III at the gates? And that, people with money in the market look at that, and if they start getting a little too doom and gloom in their attitude and what they're thinking, they're going to panic. They're going to pull money out of the market. They're going to run to safety, and they're going to feel, in large part, like that safety exists in buying gold or gold-related companies, ETFs, or they're going to put it into bonds. So that always, when there is a rush of money from stocks and private equities into the bond market, that causes stock prices to go down. It's all supply and demand situation that causes stock prices to go down, and the markets can really take a hit in something like that. Quick side note, while I was sharing that monologue about geopolitical stuff, the Dow Jones did briefly go positive and then dip back down into negative territory. So it tried really hard on this chart, and there is about 14 more minutes left of trading. But on this chart, you can see right there, just briefly, it got positive, and then it dipped back below, and now it's just I think maybe we're going to finish positive, because for the last hour and 45 minutes, it's been a relatively steady uphill climb. So we'll see what happens there. Okay, so let me come back around now and talk a little bit about our trades. I'm only going to talk about the new trade that we sent out very briefly, because tomorrow on our live podcast, I'll get into more details about it. But we went ahead and sent out a call calendar spread on Amazon. And I want to show you this chart on Amazon and tell you what my thought process was really quickly. So right here at the $210 mark is where we did an August long call, and then we did a June short call at the same strike price. And my hope is that Amazon slowly, and even with a little bit of wobbling back and forth, just kind of starts making its way back up to 210. I don't want to see it skyrocket above 210. If it did, it's a very easy trade to adjust. It's incredibly easy to roll those June 20th 210 short calls out to the next week, out a couple of weeks, even out to July if needs be, and roll them up to a higher strike price. That's if it takes off to the upside very quickly. But if it just sort of, if we get something like these last 2 weeks have brought, but with a gradual, slow upward movement towards and even a little bit above 210, you're going to see the longer term long call gain value faster than the shorter term short call. Both will gain value. They're both call options, and both will go up in value if the stock is going up in price. That's okay as long as the longer term option is gaining value faster. And then if by chance we get to the 20th of June and we do not, the stock is not trading above 210, then we might end up just buying to close the short call or rolling it out, taking in a good profit at the time, and create more of a bull call calendar where the short call option would be at a higher strike price than the long call option. So that's the tentative plan, and that's the trade we're putting on. I set a limit order to get into this trade of 775. And I opened, I sent my order in with more than 30 minutes left in open trading. As of right now, I have still not filled on that order. Watch Discord, watch our Discord channel tomorrow morning, because if it's not a lot different, I don't think it would be a big deal to pay $7.80 or even $7.85 a share for this trade. I'm hopeful that I fill in these next 10 or 11 minutes that the market is open. But if not, and if we don't get filled until tomorrow morning, we're going to do it at the same strike prices, same expiration dates. I might tweak that limit order for the trade a little bit. So watch Discord if you can in the morning, or loosen up your limit order a little bit when you listen to this. If you're comfortable getting in, I think even up to $8 a share, I might be willing to get into this trade still. I'm not going to jump right to $8 with a limit order. I'm going to test the water at 775, then maybe test it at 780, maybe go up to 785. I think I would potentially go as high as $8 because it doesn't change the dynamics of this trade in any significant way if we pay a little bit more for it. 8 would be my absolute cutoff to get into this trade. To me, it's no longer a good enough risk to reward ratio if you've got if you're paying more than $8 to get in. So that's kind of where I'm at on that. Tomorrow morning in the live podcast, I will talk more about where we're at with our spread trades. We're doing phenomenal, up almost 138%. Most of our collar trades are profiting very nicely. A couple are drawn down just a little bit, but they're situations where we've been able to add a lot more shares to them. So we don't need much movement from where they're at right now to actually see the trade be nicely profitable. But we've got some great profit in a few of them and looking good on all fronts there. And then for those triple play members, I sent out new triple play trades today for Broadcom and for Lululemon. Because we still have 3 trades open right now, we still have Dell open, we still have Marvell open, we still have NVIDIA open. Marvell is giving me a little bit of heartburn, a little bit concerned about Marvell, not concerned at all about the other 2. I think NVIDIA is going to come up far enough this week to get profitable. I think Dell is going to get nicely profitable. The stock price is trading well below. It's trading enough below our short put strike price that another day or two staying at or below 110, and we'll be able to get out with our target profit, I think, relatively easy on Dell. Marvell, it went up a little bit today. I was, of course, hopeful it would go down a little bit. So I'm not super thrilled with Marvell. We'll watch it for one more day and then make an adjustment if needs be. But Lululemon and Broadcom, I have not filled on either trade yet. I know of at least a couple of members of the program that follow the triple play trades that have filled on the Lululemon trade. Nobody has reported to me yet that they filled on Broadcom, but I will try them again tomorrow morning at the same strike prices with the same limit orders if I don't get filled before the close of the market today, which is actually just 8 minutes away. So I'm not holding my breath for getting filled on either one of those, but neither one of them report their earnings until the end of this week. In fact, the close of the market on Thursday is when they report. So we've got a couple of days to still play with these and try and get into them. I'm not losing any sleep over it at all, the fact that I haven't filled on it yet. All right, that brings us up to speed. One last comment really quickly. This will be, we get the JOLTS report tomorrow, job openings. We get the ADP, which is the private payroll report, on Wednesday. Then we get the full employment report on Friday. I think those are, I honestly think all of those reports are going to come in a little bit better than expectations. They may not be great reports. They may not be stellar reports, because there is a little bit of pressure, I think, on hiring right now. Companies that are still a little bit concerned about and uncertain about how tariffs are going to affect their bottom line, I think are a little reluctant to hire in big numbers. But we'll see. I think the expectations have been tamped down a little bit, so it may be slightly easier to hit or exceed those expectations. So I'm looking for reports that come in a little better than expected, but not real exciting, thrilling, big number reports. We'll see how that plays out. I think right now trade talk, tariff talk, and geopolitical things are going to move the markets for the rest of this week a little bit more than these reports, unless these numbers are way off, like if the private payrolls came in at half of what was expected. Let's click on this really quick and see. The expectation is for 110,000. The prior month was 62,000. If this came in at 60 or it came in at 50, like half of what the expectation is, then I think you could see a pretty ugly impact on the markets. But if it comes in anywhere close to the consensus or above, I don't think that's going to be a big a little bit above, a little bit below, right at. I don't think that's going to be a big market mover this week. I think other things are more likely to move the markets. So I'm going to wrap up right there. About 5 minutes left for the markets to close. Let's take one real quick last peek. Again, the Dow Jones is barely negative by 17 points. S&P up 16.85. It's almost 1/3%. And the Nasdaq has given up a little bit from when we started this presentation, but still up a 0.5%. And 0.5%, that's a good one-day move. In fact, that's a really good one-day move. So if everything ended right here in the next 5 minutes, I'm perfectly okay with that. All right, we'll be back on live tomorrow morning about 30 minutes after the market opens. Join us if you can. Thanks, everyone. Bye-bye.